Just shut my door. Let me know when you see me, Nancy. Nope, started. Nancy, try to call Rhonda Siegel. Okay, it's 3 o'clock, all's well. And we're gonna start this thing. There we go. Shut my volume down. There we go. So hopefully everyone's still logging in here and joining us. Still a few short from the signups. So I'm giving it kind of a minute, but I'll get started for those of you who got here on time. So thank you very much. I'm Jerry Slusowitz, your host. I'm going to be with you for somewhere between 45 minutes and an hour, I hope. Less, maybe, we'll see. But this is called the 7 Risks to Your Retirement, or the Rising Cost to Your Retirement 7 Risks. You'll see on the screen, I have this brochure called 7 Risks. It's an article piece that I wrote a while ago, talks about it. And we're going to go through that a little bit. But if anyone wants this, you can sign up. You can email us at info@pfpinvest.com. We can send you electronic version, or we'll mail it to you, snail mail, the old fashioned way, whatever you want. We'll make sure we get you this document. So anyone who wants it, I'll bring that up a couple of times, because this is kind of the bulk of what we're covering, and just not in the same order, because I wrote that piece a while ago. But a lot of people, you know, when it comes to risk their retirement, immediately they think of the stock market. You know, they say, well, you know, yeah, if the stock market goes down, you know, that's a risk to my retirement. That's just scratching the surface. It truly is. I mean, it is true. I mean, the stock market has a big effect, probably an outsized effect on more people than should be once they get to retirement. But there's a lot of other factors that go into the strategic navigation of retirement, you know, because you're basically guessing. And I don't want you to hang up and go, oh gosh, the guy said we're guessing, so I'm done with him. You got to make educated guess, okay? But what are you guessing on? Well, you know, you want to guess on things like you've got your budget. Generally, whatever you were spending going into retirement, you generally are going to continue spending through retirement. Maybe a little less on gas, a little bit less on lunches out. Maybe you're going to cook more at home. That's possible. Maybe a little less on dress clothes, although post-COVID, seems like nobody's really dressing up anymore to go to work. So I don't know about that. But you know, back in the day when you needed suits and things, men and women, you know, you saved a little bit. But overall, your heating, you know, your transportation costs, if you had a mortgage or didn't have a mortgage, those bigger fixed costs and many of your variable costs stay the same. And then a lot of times you start getting new costs when this happens. Did something happen, Nancy? Okay. You start getting new costs associated with it. I'm going to stop that share. There we go. Now I can see what's really going on. such as your hobby. I mean, people take up new hobbies, like, hey, I want to golf 3 days a week. Well, golf's not cheap. You know, I had a gentleman years ago, he said he wanted to do charitable work. I thought he was going to go down to the local SOS and volunteer his time 2, 3, 4 days a week. No, he was traveling to Miramar. He was traveling to, you know, Burma. He was going to these places for months at a time, paying his own route to go through his church and, you know, actually minister people globally to the tune of around $50,000 to $70,000 a year for his charity work. You know, so, you know, you got to put a price tag on these future costs that you need to budget in. And if you're a married couple, you know, these are things you should really talk about on, let's say, the third date, you know, before you retire, and say, you know, what are you going to do with your time? What do you plan on doing with your time if you're retiring around the same time? Because you gotta target some of that. Now, when it comes to budgeting, there's things that are out of your control, like inflation. Inflation is the rising cost of everything, including these new hobbies or these habits that you do, and your basic things like food, shelter, clothing. All those costs go up as well. So you've got to put some sort of an inflation thing on there. We're going to talk about that a little bit more. I talked about it last month. Healthcare needs, we'll talk more on that. Projecting portfolio returns. What are you really getting from your portfolio? I mean, some people, you have these good years where people make 10, 12%, and they go, oh yeah, you know, we'll project that out for forever. But what about 2022 when people on average lost 22%? Our clients didn't lose that kind of money at all. But, you know, the average portfolio, the average 401k, according to the Bureau of Labor Statistics, was down, I think, 23% in 2022. So if you got a quarter less money to live off of, you know, that could be a problem if it's all in the market, which again, we'll talk about that in a minute. But inflation, taxes, who thinks taxes are going down? Anybody? You know, I don't see any hands up. You know, taxes aren't going to go down. Taxes are going to go higher. So, you know, those are all things that would take away from your retirement assets and your retirement income. And then the last one is life expectancy. And again, we're going to detail these all out a little bit more as we go forward. But life expectancy, I mean, people tell me all the time, well, you know, I'm going to spend down all my money. I go, okay, so when do you plan on dying? Like, what do you mean? You know, it's just like, oh, I got my money in the stock market. I don't really need the money. I'm going to leave it to my children, my grandchildren. Well, when do you plan on dying? Like, what do you mean? Are you crazy? Well, are you going to be dying in an up market, or are you going to be dying in a down market? Because if you die in a down market, you're leaving less for your estate. You die in an up market. So leaving a legacy in the stock market isn't always a great idea either. But life expectancy is really, really important, because what happens is things really, you know, people are living longer than ever before. So what do I mean by that? Let's go here, and I do see a chat. I'll give those rules again. I appreciate someone entering the chat, but let me read the chat right now. So hopefully you see this new screen, right? Okay. John, my taxes went way down when I moved to Tennessee. Yes, they did, sir. Yes, they did. Yeah, I had a client move to out of state to I don't know if it's a zero tax state. I'm not exactly sure on that one, but taxes went down. Hey, a lot of people's taxes go down when they retire because they don't have the big income that they had. So, you know, that is possible. But what I'm talking about on the taxes is the Tax and Job Act, sometimes known affectionately as the Trump tax cuts. And it didn't cut for everybody, especially those in California. But that had a 7-year life expectancy from 2018. So 2025, they will expire, and there's going to be some new taxation unless they extend it, which I doubt very heavily they'll extend it. I think they're going to write something new, because we were in debt. I think it was 22 trillion in 2017, and now we're 32 trillion in debt as a nation. Okay, so let's move on here to longer life expectancies. They call these centenarians living to be 100. In the year 2000, 50,000 people were alive at 100 years old. Okay, seems like a lot. In 2050, they expect 1 million. So people are going, well, 2050, that seems like a long ways away. Well, it's 27 years. So if you're 73 or less, you know, you could be one of these 1 million people in 2050 that's going to be, you know, 100 years old. Have you planned for that? Have you thought about that? I mean, let's say you don't make 100. Let's say you make 92 or 95. Have you planned for that? Because it's a snowball effect. Again, I'm from the Midwest, and a snowball, you start on top of a hill, you get a little snowball, and you start rolling it down the hill, and it becomes bigger because if it's wet snow, it can gather the snow and get bigger and bigger and bigger, and it becomes unwieldy. And at the bottom, it's this big problem because if it comes at people, it can really do some damage. Well, guess what? Living longer can do some damage as well, because what's going to happen? The longer you live, the more bear markets you're going to have to face. All right, the more bad markets there are. So if you live longer, then there's more chance of the stock market riding on you. So do you want to be dependent on the stock market? Not really. You really don't. Guess what else happens? Healthcare costs are rising faster than most other costs. So the longer you live, the more chance you have for more healthcare issues. So that's going to cost you more and more and more every time that goes on. Plus your daily expenses, paying for your heating, air conditioning, food, all those things. The longer you live, the more money you spend on all those items as well. So that's what I mean by a snowball effect. There's more things that could go wrong. There's more health issues. There's more costs. And then there's more risks on your money lasting as long as you do. And the thing is a lot of people look and they go, well, my parents died, at 55 or whatever. And, I'm not going to make it. And what are your health issues? Well, I don't know. I don't have it. They're in their 70s. So, it's the old, prepare for the worst, but hope for the best. And that's kind of what you've got to do is you've got to prepare for making your money last. I see people all the time. They come in there and they say, okay, I need $5,000 a month and I get $2,000 from Social Security. So $3,000 for my investments. And yeah, I've got my $5,000 a month and my expenses are $5,000 a month. So I'm good. Today, if you're 70 and that's all the income you can generate is 5,000 and all your expenses are 5,000. Well, last year with inflation, those costs went up 10%. So that's 5,500 this year. So now you're upside down. Now you're taking 500 out of your principal, bringing that down. And then this year to date, they're saying, well, inflation's going down. Inflation's not going down. The rate of inflation is growing less fast. Last year it grew at 10%. Now, after this 10% threshold, now we're only growing at 5%. Let me try to see my angles. That was 10, that was 5. But so let's say again, $5,000 worth of expenses in 2021 at the December 31st of 2021 cost you $5,500 because of 10% inflation at the end of 22. And now at a 5% inflation, that's going to still be, another whatever, $250 more. So 5,750 if we stay at 5% between now and the end of the year. So inflation, it's not like, well, I was spending 5,000 and went to 6,000. Now it's back to 5,000. It just means it went from 5,000 to 5,500 now to 5,750. So the rate of your expenses are going up less slow. So that again is one of the problems with a longer life expectancy. And the reality is people are living longer than ever before, and they're doing it. Okay, stock market risk. Okay, for far too many of you folks, you're far too dependent on the stock market for your returns. And if you look again, this is last year. Hopefully you see the S&P 500. Okay, so this was a year ago. This was back at the beginning of the year. It was around 4,800. The S&P 500 was 4,800 over here back in January of 21 on the left-hand side over here. And it went down, 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 down. And we went down to 3,491. Well, that's down 27% from the peak, okay? And then we did rally up some, but by the end of the year, we were still down 18% on the year, okay? So down 18 on the year. And now, from the end of the year, which was like right around here, yeah, the market's come up a little bit, but you can see since January, the end of January, the market's just kind of going sideways, and that's really where we are. I'm gonna clean this up. But the market technically from December and January is more or less just going sideways. You got an up and a down and an up. And that's okay, because here was that banking crisis right in there. And it didn't take us beyond these lows of late December. The lows here in March were slightly higher than that, but we also still haven't taken out this top from late January. So this market, I mean, some people are wondering, I just wrote this this memo saying, well, the market's kind of going sideways. It is, but this is the problem. This right over here is when you're losing 27% on your money. That's where you start running into problems, because people get emotional. They don't have any discipline. They don't have anything out there in terms of ability to control themselves from making a wrong decision. I've got to explain something. I talk to my clients, and not all of you guys are clients that are on here, but I talk to my clients and I say, hey, look, it's important to understand that we're not an institution. An institution like a mutual fund or like the Harvard Endowment or the CalPERS, the state pension for employees, they have to remain invested. You don't. If the stock market is going up, you want to participate. But if the market's going down, you want to find alternatives. And we've been talking about that. There are alternatives out there, like right now with the treasuries, and they're still paying about 4.7, 4.8% for 6 months. No state tax. So, but people go, well, I'm going to miss out on the stock market. Well, if the market's going sideways or down, you're not missing out on anything. Because, sometimes zero exposure to the market, if it's dropping, is better than having the market exposure and losing money. So you can have a fixed rate guaranteed by the U.S. Treasury and get 4.7, 4.8%. But it's really important to understand that emotions cause real trouble, and they sell at the wrong time and they buy at the wrong time. So what we're talking about is managing risk based on some sort of methodology, some sort of proven track record, like what we have with our 35 years, that if you want to have us talk to you about your portfolio, we'd be happy to. 949-219-0692, or send us an email, and at info@PFP for Pacific Financial Planners and the word invest.com, and we'll be happy to take a look and do a retirement risk analysis for you. Because what you want to have is a strategy where when you see the markets, let me go back to this again. There we go. Hey, and by the way, as I get over to this, at the bottom of your screen, you'll see chat. And if you go on chat and start typing it in, I'll see your question or a Q&A, and I'll see your question and I'll take your questions. But you can see, I'm gonna change the screen up. Can you see the S&P 500? I believe so. You can see that this market was going up for a long time. Then we had the COVID crisis right in here. But you see it really knocked out most of the year. But by the end of the year, we actually were continuing this uptrend. So this uptrend continued, and really, this was a very long uptrend, other than the little COVID crisis in here, which created some opportunity for our clients because we got out here and got back in here. That was a good idea. But as you can see, this thing kind of going up, you'll see you have a low and a high, and then a higher low and a higher high and a higher low and a higher high and a higher low and then a higher high. You can see that this thing's just trending up. But then when we got to last year, you had this peak in there, and then it went down, and now suddenly the low from late 21 and early 22 was lower than that low. And then when we came back and had a lower high than the previous highs, that should have been your signal to maybe get out. So I'm going to change the screen to look more like it does over here. So here's your high, here's your low, here's your lower high, and certainly by around here, you ought to be getting out, all right? And you would have avoided this big drop down to here, because what you see is a series of a high and a low and a lower high. I mean, a lower low and a lower high and a lower low and a lower high and a lower low. And we still had a lower high, but now in December, we had a higher low. So this is October right down here. This is December, and now you have a higher high in March. So now it's possible to be trending up, or it's possible it could be trending sideways. So if you've got dividend paying investments in a sideways trending market, you're okay. But maybe the best thing to do would be to have some exposure to the market and then some exposure to safety. Now, if you invest for income where the dividends are paying your income, then you're in a pretty good shape. So I'm going to use a different example now. I'm going to go to my whiteboard and I'm going to say, so total return, you guys have seen this before, I know you have, comes from growth, which is how most people think of it, but it also comes from income. And you can get your return either from growth or income. And you can actually, to some great degree, get more return by having the right income investments chosen, because they're generally safer, because they're already paying you immediate money in terms of dividends and interest. And generally speaking, when you have more safety, you can get better return. How do I mean? Well, when you have a growth investment, that growth investment can turn into a loss when you have a down market like we did last year. And a lot of people don't understand the laws of inverse math, but when the market goes down 25% like it did last year, and you have, let's say, $1 million portfolio, all right, so that $1 million, when you lose 25%, is now worth $750K. So how much return on this $750K, because that's all you got left, do you need to get $1 million? You don't need a 25% return. No, you need a 33% return. See, that's that law of inverse math. When it goes down, these losses can compound. Where if you're investing for income, it's safer, generally doesn't go down as much, so you need less return to make more money. So if you're only down 10%, let's say in an income portfolio, and then this comes back 33%, now you're breaking even. We're here, let's say you only make up, let's say 20%, you're already more than even, you're up 9 or 10% on your portfolio, while these guys are just breaking even from a pure growth portfolio. So investing for income makes a lot of sense. But the problem is too, is when it comes time where you're forced to take what's called your required minimum distribution, which is now moved to age 73. If you have not started your required minimum distributions, your RMD, you have until age 73 to start now. So that's pretty good. But what happens is if you're taking something, your portfolio is going down, and let's say you need to draw $5,000 out a month, okay? And that's how much you need, which is equal to $60,000 a year, and you had $1 million, okay? And now you lose that 25%. You didn't lose just 25%, because that's 250,000. You really lost 31%. Okay, because you lost the 250,000 plus the 60K that you drew off. So now again, when you lose a third of your money, you need 50% to break even. Okay, let me just give you that example again. So again, you had $1 million goes down to 666. Well, you need 333 off of that 666, which is 50%, just to break even. So that's why when you're taking your RMD, it's better not to take it off of growth investments, but to take it off of dividends and income that pay that. So the example I give many times is, let's say you're into housing, and some people want to buy houses and they want to flip them. They want to buy a house for, $600,000 and they want to sell it for $850,000. Okay, well that's kind of cool. You're trying to grow your money. But what if instead you rented this out and used this as a rental income, okay? And let's say you needed, $3,000 a month as income, and now you're starting to get $3,000 a month rent. Do you care if this goes up in value or down in value, as long as you're collecting your $3,000 a month rent? So rental properties like setting up income investments, and that's kind of what you want to do. I know you guys have talked about it before, or I've talked about it before, is just having a chicken farm. And if you have chickens, okay, let's just see if I can draw a chicken. I don't know if that looks like a chicken or not, but you could eat your chickens by killing chickens, or you can eat eggs. And the interest income is like eating the eggs. And where growth investments are trying to breed chickens, you have more chickens, but you're growing your chickens and then you're eating them, which is again investing in the stock market for growth versus investing in the stock market for dividends and interest. So what we aspire to is our clients invest more designed for the income and the interest and dividends, and that continues to pay in any kind of environment. But we also don't want to invest where we lose 18% to try to get a 6% dividend. That's really important that we separate that out. So we still use our stop losses, but that's the stock market risk becoming too much. All right. So another problem is sequence of returns. And this becomes a problem when you retire, is if you draw too much too early. Far too many people, when they retire, what they do is they want to travel. They want to go see their friends and relatives around the country. They want to go see Europe or Asia, places they wanted to see. And that's okay. I mean, believe me, you've been working your whole life, you deserve some break, but you've got to mentally kind of start planning, because I've seen it many times over my 35-year career where people spend way too much money at the beginning of their retirement. And then they have not enough to create the income that they need later on, because inflation makes their costs go up. I'm not saying live a dull, dreary lifestyle, but you've got to think wisely from spending too much. And I get it. Retirement, there's 3 stages. There's your go-go years, your slow-go years, and your no-go years. You take my dad at the end of his life, he had plenty of money, but he had no go. He couldn't walk. He didn't feel like dealing with hassles, etc. So he didn't do much. So I get it that you want to do stuff early, but you've got to really strategically plan this out. These are risks to your retirement: living longer, having the stock market for all of your income, investing for growth. But then you also sequence of returns. Richard says if you lose 18% on a dividend stock and you get 6% return, you'll get that money back in only 3 years. Yeah, correct. But you took the 6% because you needed to spend that. Forgot about that part. So you've got to, if you're spending that money, then you've got a problem. What if you got, let's say you lost 2 or 3%, got out of that 6% dividend, replaced it with a 4% treasury. Now you're losing 2 or 3% on principal, 2% there, and then the market starts to come back and you're buying at a lower price. So it's a good guess, Richard. It really is, but you don't know when you're down 18% if that investment that just lost 18% is now going to lose 36%, and you're getting 6%. Now it takes 6 years to get back. Plus, remember, most of my clients are spending that 6%. But if you're still working, you could say you could make it back in only 3 years. I just think that there's a better way. We'll talk about that in a little bit. But good observation, Richard. But if you're spending that 6%, then you really don't ever make that money back unless the market comes back that 18%. All right. So retiring in a bear market is tougher. I mean, a lot of people in 2007, 2008, they held off on retirement. Hey, look, I mean, prior to the financial crisis in the mid 2000 era, 2009, 2005, 2006, 2007, in that first part of the decade, most people were retiring at 62. Why? Because you get Social Security, right? That was the age you get Social Security. Now the retirement age is all the way back up to 66. So, it moved back because that financial crisis caused a lot of people to rethink, hey, look, I can't afford to retire right now. I got to work for a few more years. I lost principal. I need more time. So retiring in a bad market, not that you can control it, but that can be detrimental if you've got too much exposure to the stock market. What you really need is an income plan. That's what you really need, is an income plan of how are you going to get the income that you need safely and with longevity to last the rest of your life. So we'll get on that a little bit more. And again, when I talk about these income plans, I one more time want to make sure that you understand that the income has to account for inflation. So today's inflation rate is around 6%, let's say, okay? That's today's rate. And this is after last year being 10%. So let's say you need $5,000 per month, okay, from your portfolio to live on, because this is what your expenses are. Let's say you have Social Security, or maybe you got a pension or whatever, but this is how much you need from your investments. And if the inflation rate is 6%, then that means next year you're going to need again $300 more, right? Because 6 times 5 is 0.06 times 5,000 is $300. So you would need more. Well, let's just take that out 10 years. So this is again 5,000 times 12 is $60,000 a year. Okay, this is per year. Okay, and this is per month. So in 10 years, how much do you need per year off of your portfolio? Well, I did the math for us. You're going to need $107,000. And in 20 years, remember I was talking about how long people are living, that in the next 25 years, we expect to go from 50,000 to 1 million people living to be 100. So in 20 years, you would need $192,000 will equal your $5,000 a month withdrawal now. So people have not figured out this inflation factor for future cost of living. And if you think, well, that's crazy, this is the consumer price index, and the senior price index, which is for 65 and above, because of healthcare, is always significantly higher than the consumer price index, which is for people 18 to 65. So the senior price index is even scarier than needing the 6% inflation now. So you've got to be worried a little bit about that. All right. Let me go over to another screen over here. Nope. Bear with me. I'm sorry. You'd think that one of these days I'd do this right, but it just doesn't happen. Here we go. All right, let me share this again. So we're talking about risky retirement, underestimating inflation. Inflation means things cost more. Inflating prices, like you take a little balloon and you blow it up, it gets bigger and bigger and bigger. Healthcare costs rising faster, and unexpected events. What are the unexpected events that can happen? Well, death of a spouse. You got a dual income. I've seen it where, one spouse has a higher income than the other. And while pensions have today a little bit more impact that, some of that can pay to the surviving spouse, this is why a lot of people hate annuities back in the day. When you get a pension, you know what that is, right? It's an annuity, right? You win the lottery, you know what that is. It's an annuity. I know that some people out there go, I hate annuities. I'll never buy an annuity. Most people like their pensions. If I remember ever in a room and say, who likes their pension? Everyone raise their hand. Does anyone dislike the pension? And nobody raises their hands. I don't know why. So people love annuities because a pension is an annuity. But back in the day, this is what caused some of the annuity issues, is they didn't give as many choices to the retirees. So you had this guy retiring at age 65, and he signs on the bottom line that he's going to get $5,000 a month for life. And 2 months later, he dies. His spouse got nothing. So all she has is her Social Security. Maybe she stepped up to getting the widow's benefits to his Social Security, but that pension, that annuity money went away. That's what caused a lot of angst. Nowadays, it's a little clearer, although I still see people making the mistake, because once you sign that dotted line, it's irrevocable. Just like if you ever buy an annuity, it is usually penalistic for 5, 7, 10, even 15 years. So before signing on the dotted line, get a second opinion. Give us a call, 949-219-0692. We'll be happy to do a review. If you're taking a pension or retiring, or if you've got a friend or neighbor, relative retiring, have them let us give us that retirement risk report. It is so important to have that done before versus after. I had a lady come in to see me, I think it was yesterday. Yes, today's Tuesday, so it was yesterday. And she she put all her money into a variable annuity. And while it's okay, variable annuities are the ones with the high cost. And she said, well, it's really high cost. And I said, yeah, but she had an income rider on there that now she's kind of stuck with, but it's okay. But that's all it is okay. She's one of those who's going to suffer the more inflation comes along. And she was only around, she was in her mid-70s. So, but mid-70s, she's got, maybe another 15 years left. 15 years more of inflation means she's shrinking her ability to live because all she has is that income and her Social Security, and she's right now flat with her expenses. So she's got nowhere to go other than maybe sell her property, downsize, rent, and that's none of those things are good options, by the way. So it's really important to understand that. So unexpected events, death of a spouse, a health issue. And look, I don't know how many of you guys are still working, how many's retired. I usually see the list of who's on here. I saw who was signed up, but who's on here I see afterwards. The bottom line is that 65% of people don't retire when they want to. They retire because they have to. They have a health issue. They can't work anymore. Their loved one has a health issue. They have to stay home and take care of them. I've seen, I got a guy right now, just recently, he had to retire because he has to take care of his mother. I mean, there's nobody else to take care of her. He's got to do it full time. So he had to retire at 62, take his Social Security at the lower rate. He's not even on Medicare yet, so he's got to pay that for himself for another 3 years. So, I mean, that's an unexpected event from a health issue of a loved one, not even him, becoming incapacitated. Here's another one, unexpected events. We're talking about risks to your retirement. I meet people all the time. I work a lot. There's a retirement community nearby that I work with, and they say, well, I do it myself. Cool, you do it yourself. That's fine. A gentleman one time was saying, well, I'm a professional, I was a CPA, I'm good with numbers, I do it all myself, and this and that. And I'm like, great. I mean, I'm an engineer by degree. I mean, I got an engineering degree. You can learn how to do this. You just need the time, the temperament, and the talent to do it. How do you know if you have those? Well, try it and see. If you don't have the time to dedicate and investigate and research it, you're going against these sharks, on the New York Stock Exchange, on Wall Street, who like nothing better than to bite off a chunk of your retirement and live off of your money because they're sharks out there. The second thing is temperament. I was talking about emotions. People make bad decisions because they get emotional. Richard asked this question. He said, if you lose 18% on a dividend stock, get 6% return, you get the money back in 3 years, as long as it doesn't go down to 36%. I mean, so how do you know? How do you know that 18 is the number? I mean, if you knew 18 was the number, why did you buy it in the first place? Why didn't you skip the 6% dividend, wait for it to drop 18%, then buy it? The dividend would be an effectively higher yield because the price has gone down, as long as they could pay the dividend. So, you start guessing, and that's the problem with temperament, is you can't guess, you've got to have a plan, all right? And again, I'm going to digress right here for 1 second. Got the time, we're doing pretty good on time. And anyone who has a question, go into the chat or into the other section. It's Q&A, chat or Q&A. But here's the thing is that, so when you invest, and I know many of you have seen this before, what you want is you want the price of your investment to go up over time, right? So they say the best way to make money is to buy something at 20 and then watch it grow and grow and grow and to sell it at 30. That's what they say. This is an old Wall Street adage. Great, we're done. But what if the day you buy it at 20, it starts to go from 20 down to 18, 15, 12, and then down to 10? So what happens in this scenario one, I'll call it, is most people start to hope, and they're not hoping to get back to 30 anymore. What they're hoping to do is to just get back to 20. And sometimes even if they get halfway back, they start to sell because hope is a horrible investment strategy. I mean, I ask people all the time, I say, why don't you talk to your financial advisor and ask them what their sell discipline is? Because how do you make money? I mean, do you make money if you buy a stock at 25 and it goes to 125? Seems like you did, right? But if you don't use that little 4-letter word and sell, and it goes back down from 125 down to 10, and you bought it at 25, was that a good investment or a bad investment? Seemed like a good investment, but it turned out to be a bad investment because you forgot that there's two parts of the equation to making money. It's to buy and to sell. That's the only way you make money. If you buy and hold, you may be up today and you may be down sometime in the future. So that, people go, well, I invest for the long term. Of course you do. There isn't a person alive that doesn't invest for the long term. It's just a matter of, if you're not investing for the long, term, what happened? Well, you died, so your long term is over, or you ran out of money. Right? You stopped investing because why? Because you ran out of money. So they say, oh, I invest for the long term. It's kind of like, oh, okay, Captain Obvious. You're really kind of not saying anything. You're saying the obvious. It's like everybody invests because you have money and they're alive, so they've got to invest it somewhere, right? So now it's a matter of, do you want to make money? How do you make money? It's two parts. You can buy and sell, and you can live off of interest dividends as well. So let me go back to this equation over here. Hopefully that makes sense. Is the scenario one is you hope when you lose money, and that's kind of a really bad strategy. So what we do is we put a safety net below the market. So when we're buying at 20, we already determine how much is the maximum amount of money. And again, there's slippage and things like that. We want to take our maximum risk on that position the day we buy it. And we want to figure out what that maximum risk is, because we know that no one, me, you, Warren Buffett, none of us can predict the outcome. We can make a great case. I did radio for 20 years. I can use this forum right now and sound like, oh, yes, I know what I'm talking about. Here's what's going to happen. It's going to go like this, and it's going to go like, and I could say it that way. And I might be right a lot of the time, but I know some of the time I'm not going to be right. So I don't try to pretend that I or anyone else can predict the outcome. But what we can do is control the risk. And if you don't control the risk, you're gambling. You really are just gambling. I talk to people all the time. They say, well, I'm a conservative investor. I had a woman in here recently with her daughter, and the woman, she was a little bit older. She goes, oh, I'm extremely conservative. I'm extremely conservative. Yet she had one half of her money, and it was a fair amount of money, in the stock market with no risk management plan. No plan at all to manage the risk. It's just riding along like, hey, I want to go to Catalina. We're here in Southern California. And so I'm going to launch a boat out of Newport Beach, Newport Harbor. I'm not going to have a sail. I'm not going to have an engine. I'm not going to have a rudder. I'm not going to have any oars. I'm just going to go out there and hope that I hit, Catalina as we bounce around, with the waves. I mean, like, that's investing and saying you're conservative without a risk management plan. So we have a maximum risk management at the beginning. And then if it goes, here's option two, is if it starts to go from 20 up towards 30, we want to raise that safety net. And every time the market goes back down and has an inflection low and goes higher than the previous high, goes an inflection low, goes higher than the previous high, we can keep raising our stop. It goes to an inflection high, an inflection low, passes the previous high, we can raise the stop. So let's say the stop's now at 25, we are controlling our risk. And therefore, going back to Richard's question or comment, that, hey, if it's only down 18%, you're collecting 6%, you get your money back in 3 years, as long as it doesn't continue to go down. With our strategies, we have it protected at all times. They say defense wins championships in sports. Well, guess what? Investing is like a sport. You want to play defense at all times. So what happens here is people say, well, what if it goes down to 25 and hits your stop? Well, then we sell it. And the question automatically is, well, what happens if it goes up after we sell it? You mean it goes up without you? You lose opportunity. You lose the opportunity. But if it kept going down with you, you would lose real money. So, kind of like this client who came to see me recently that had half her money in the stock market with no plan. What's more important, protecting your nest egg or protecting opportunity? Same with you, Richard, is what's more important is, opportunity or real money. For most of my clients that are near or at retirement, because remember, when you're like 5-6 years before retirement and through retirement, that 10-year period of time, you generally have more money than you have ever in your life. Now, some people can continue to grow, and that goes back down to their income versus their expenses. Like, my mom, been retired for forever, but her income coming in is much greater than her expenses. So her net worth has risen every single year for the most part, right? But that doesn't happen to all of you. For many of you, you're at the pinnacle when you retire, because you got to take that portfolio and make a mind shift from growing your money when you were 20 in a 401k, or 30 or 40, 50 years old in a 401k, trying to grow, save for retirement, get that money higher and higher and higher. Now you give up the paycheck, you're at retirement. What are you starting to do? You're starting to go down the mountain on the other side. Now, I don't know if any of you have ever rock climbed or gone up to Yosemite or done any of these places like Half Dome, but I'll tell you, going up while it's more strenuous when you're going up, because you're hopping and popping, carrying a pack. Going down is more scary, because they say when you're going up steep cliffs, 2000, there's what's called the Abyss. I think that's in the Grand Canyon. I was there last year. You got these 2,000-3,000 foot sheer cliffs. Certainly on Half Dome they have those. They say don't look down. Well, when you're going uphill, you're looking up. It's great. But when you're going down the mountain and you're on some stairs with a sheer cliff off to your left-hand side like this, they say don't look down. Well, you're looking down to see where you're going to put your foot. I'm telling you, it's scary spending down your assets. So when you get to that pinnacle of retirement, of having more money than you've ever had in your life, you better have a protection plan in place. You need to have that. Okay, it's a must. All right. So that was a long digression, but okay. Anyone who got a question, just put it in Q&A. You want to chat, put it in there. I'll be happy to read it. So we were talking about unexpected events, becoming incapacitated. I was talking about this gentleman who was a CPA, met recently. He said, well, I'm a CPA, I do it myself. I said, okay, now what happens if something happens to you? Well, my children get the money. I said, no. You're alive. You become incapacitated. Your mind becomes, aged. It happens. Not everybody. I mean, like I said, I met this woman and her daughter the other day. She was sharp as a tack, the woman. I mean, really, obviously you could say for her age, brilliant. But, other people, I won't mention any names, but, we see it all the time. They're 70 or 80 years old and their mind's not so good. We all know who they are. I mean, I'm not being critical. This is all health. I mean, I'm getting there, not wood. I'm going in that direction. We all are. Some people maintain their mental capacity, other people don't, and it's at different paces for different people. Having your health is a blessing, but you become incapacitated. Now who's going to make the decisions? Because now you probably need someone to care for you. You need someone where are you going to spend the money? Where are you going to draw from? How are you going to make that money last? And a lot of people don't have a plan for that. So an unexpected events could be incapacitation of you. Now, some of it could happen quickly. I had a client years ago. He went out, he was living in the village, Laguna Woods. He went to pick up his globe, on a Thursday morning, and he bent down, and his driveway was on a little bit of a slant, and he fell forward and he hit his frontal lobe. He looked all fine. This guy was a strapping, like 6'4", good-looking retiree guy. His wife had passed years before, nicest guy in the world. But when he hit his frontal lobe, he had frontal lobe damage. That becomes a problem. Like you're like a little kid. You say the first thing out of your mouth. You can't care for yourself. You got to relearn how to eat, talk, everything. And that's what happened to my client. Unfortunately, he's deceased now. But he went from being able to be independent living to not functioning all at once. Other people, it happens more slowly. Okay, over a period of time, their mind starts to degrade. Maybe they don't notice it as much. But if you're not as sharp on making your decision, who's going to manage the money? Who's going to take care of the risk? Who's going to make sure your money lasts till you're 95 to 100 years old? So it's really important that you have that strategy in place. Another risk of unexpected results are children and relatives. I got to tell you, children meddle all the time. I was on years ago, I was on what was it called? Anyways, it was Orange County FAST team, Financial Abuse Specialist team. It was set through the Orange County Council on Aging. We were with the FBI, we were with law enforcement, we were with the medical community. I was representing the financial community. And they say there's a lot of financial abuse of financial advisors, CPAs, attorneys stealing people's money. It is, that's true. But 75% of financial abuse comes from the family. 75% of financial abuse comes from one's own family. Tragic as that is, but that is a true statistic. We were dealing with the other 25%. We were doing a little bit with the families too, because you had these kids that were buying, retreats and cabins up in Big Bear and saying, "Oh, Grandpa wants to go," and Grandpa's meanwhile in a nursing home, not able to get out. So yeah, really, that's for Grandpa. They were spending their inheritance early, but clients who have children who get married and divorced and married and divorced and married and divorced, and they got kids with all these different people, and every time it's the guy's fault but never their daughter's fault. I've seen that before, and they spend down their retirement to where now, instead of having a very full lifestyle, they're worried about running out of money, and they really retired fairly wealthy. And I see it all the time. And then another unexpected event is doing nothing while the world changes. Look, the world has changed dramatically over the last few years. From 2019 to today, it's significantly different. The onset of COVID changed our world. We all recognize that, right? I mean, I still see someone pulling out next door, driving alone in a car with a mask on. Their belief, I mean, that's fine, is that they need it. Maybe they do. Maybe there's other health issues I don't know. So I'm not trying to be critical of people, but it changed the mindset of a lot of people. Social integration, children are behind with speech therapy, socialization of youth. I mean, we see a lot more killings and all that sort of stuff. A lot of this had to do with COVID, the lockdowns, the separation, the lack of connection. Older people too, lack of connection because of COVID. That changed. We also went from a declining inflation, declining interest rate environment from the early 1980s to where we had 0.3 on the 10-year treasury, 0.3%, less than 1%. The 10-year treasury has been around for 250 years of the United States history, all 250 years of U.S. history. It's never been below 1%. We had the lowest interest rates, not just in our lifetime, but in anyone in the United States ever lifetime. And now we're starting to see inflation come. We're starting to see interest rates come up. So the world's changed. But I see a lot of people who have portfolios whose husband set it up, all right, or their wife set it up, or their former advisor set it up, and they don't know what to do, so they don't want to change a thing. There is a cost to do another. We're in a whole different paradigm. Since 2009, you couldn't get any interest rate on CDs. Now you can get 4.5, even 5% on a CD. So you got to look around and come up with an income. So there's also healthcare costs. Excuse me. Let me go back to this right here. Hang on for a minute. Bear with me. I'm getting there. There we go. Let me share this screen. There you go. So again, for those of you who joined us late, I have this brochure, 7 Risks to Your Retirement, something I wrote. And again, so talks about these things we're talking about: longer lifespan, spending principle, underestimating inflation. You can see this, right? Underestimating healthcare costs. This is the one we were on. Common mistake retirees make is they think that they're on Medicare, so there's no cost. Well, they're saying full-time healthcare costs. This is long-term care. They're saying could be $200,000 a year, but your out-of-pocket healthcare costs per person, it is estimated out of pocket is $250,000 between age 65 and retirement. I mean, in retirement, in death, between age 65 and death, $250,000 per person. Married couple, you're talking about $500,000. Who's got that kind of money saved up? Have you identified that? And then you throw in long-term care on top of that. My mom right now, tragic. She had a car, and then she had a golf cart. She lives in a retirement community, and they ride golf carts as they do, right? So she wanted to go to a meeting. Her car wouldn't start. She called her version of AAA. Nice gentleman comes over, jumps her car, starts it up. Good to go. Go on, go to your meeting. And my mom goes, hey, wait a minute. I haven't been driving my golf cart because it's been winter. Now it's finally warming up. I want to start driving my golf cart again. You mind charging that? So the kind gentleman says, sure, starts charging it, but it's electric. With a car, you turn the key, right? You hear an engine. Oh, hey, look, it started. The battery's charged. With a golf cart, you don't have that. So there was no indication that his charging worked. other than to kick it in gear. Golf carts have the double brake. You put a brake on and you brake it again, and that's like a parking brake. How do you get it out? Well, you press the gas, and a lot of times that brake pops out and makes a big noise. If you ever played golf, you know what I'm talking about. And sometimes the golf cart lurches forward. Well, my mom's standing next to it. She had the doors, the winter doors on, which are like a Jeep door, plastic, and it smacked her, and she went down so fast she didn't even put her arms out, which is good because she probably would have broke her wrists, her hands, or arms. She had no bruises on her arm, but she had a contusion on her head. She broke 4 ribs here, broke her pelvis, and had contusions on her legs because she got knocked down by a golf cart. So she spent 2 weeks in the hospital, now another week in this nursing care, and now she's going to go home, and we're going to get someone to be with her in her home for 8 hours a day starting tomorrow. Okay, and that's when she's going home. So that is what I'm talking about, is healthcare risk. So it's $40 an hour, you know, to have someone come in your home. But again, I don't think she's going to need to stay there that long. And I think maybe in another week or two, because she's shown dramatic improvement versus a stay in the hospital, now a skilled nursing center. But you could stay in a home for $6,000 or $12,000 in a nursing center, and $20,000 to $24,000 at home. But we're going to do some temporary at home to see if she can still live in her own home and have that independence come back. And she did only break bones, thank God, but it could have been worse. So my point is, that's an out-of-pocket expense. Now, some of you are saying, well, geez, he's trying to sell long-term care. No, I'm not. If you want to, sure, I'll give you an estimate. But if you're older, if you're over 70, yeah, you can still do it, but it's going to be very expensive. But if you're younger than 70, yeah, maybe it might be taking a worth of a look at a plan. But if you want, what I'm trying to advocate is that you have to identify and allocate certain investments in your portfolio that says, this is what we're going to hold for my long-term care. If I need to go into a facility or, have at-home care, here's where the first 100,000 is going to come from. Oh, if I'm still alive and we still need help, here's where the second 100,000. And your caregiver has to identify that. If you don't know, if they don't know that they're your caregiver, first off, so you should have that family meeting conversation. Here's who's going to care for me. Here's who's got access to my money. And then here's the assets that we're going to use for long-term care. And if you don't want to talk to, let's say it's a child or somebody like that now, don't, that's okay. But pre-identify that you have it in writing and that person who's going to be your caregiver knows, hey, you're going to be my caregiver. Call my financial advisor, call my attorney. You're on my bank safe. Go to my safe. There'll be instructions about what to do to me in case I'm incapacitated. So really important. And then long-term care, like I said, that's the whole thing. It's $250,000 per person, and then anywhere from $6,000 to $20,000, 24,000 if you're doing in-home care. $40 an hour right now. So times 24, you do the math. So and then again, counting on the stock market to engineer your returns is in this brochure. Let me get back to that. Here you go. And I'd be happy to send this. Just email us at info@pfpinvest or call us, Nancy at 949-219-0692. So this is a brochure. I'd be happy to send it to you. It kind of covers a lot of this stuff. You just want to have that well thought out income plan. Income, not growth, to have your money last till at least 90, and you might live to 100. You might be one of those people. But a lot of people are just winging it. I mean, that's really what they're doing. They say they're conservative, but really they have, what's your plan? I have no plan. What's your continuity plan? What's your plan if you're incapacitated? I don't know. How are you going to play for long-term care? Which assets are you going to use first? I don't know. But I'm conservative. No, you're just winging it. That's what you are. You're gambling, go to Vegas, and you're winging it. That's really what it is. It's really important. We've developed a proprietary report that's customized just for you if you want. We call it your retirement risk report. It's absolutely free. There's no obligation. I have people come in here all the time. We had another lady come in, I think it was yesterday as well. And I looked at her portfolio and I said, this is excellent. Okay, this is excellent. This is excellent. She had about 800,000 and maybe 60,000 of it was at risk. Other than that, everything was good. I've had other people come in. Hey, look, you're in good shape. You're in good shape. I'll tell you, you'll see it. It's not me telling you. I help people visualize and see what they have in their portfolio and how safe versus how risky it is. You'll know. We call it your retirement risk report. It's absolutely free. There's no obligation. If you call us and schedule, okay, call Nancy 949-219-0692. Send it an email, info, info, like as an information, info at PFP for Pacific Financial Planners. Is right here, PFP, Pacific Financial Planners, just the first three letters, and then write the word invest. Spell that out, invest.com, Jerry at pfpinvest.com, and say, hey, look, I want that retirement risk report. We can do this over the phone, we can do it via Zoom, we can do it in person. And again, if you've got money invested in markets or in anything, you only get one shot at retirement. Don't you think you ought to get it right? Don't you think it's important enough to get a second opinion? If you were going for heart surgery and someone said, hey, your heart's all messed up, would you let your general practitioner do it? Would you go to the cheapest guy at the urgent care? Or would you try to find a specialist? I'm a retirement income specialist. What I really am is a retirement risk specialist. I'll show you the risks to your retirement portfolio. It's absolutely free. You can take the information and go do it, whatever you want. And we're not talking about a boilerplate 100 pages. It's a one-page deal. It's one page. I'll answer any questions, any concerns you have, one-on-one. Call me up. Be happy to go through it with you, one-on-one. If you have any questions, any concerns, or if you want a free, no obligation, second opinion from a real authoritarian on the markets, that's me. Be happy to help you. 949-219-0692. And again, if you want to get that free report that I was talking about here, that I was referencing this entire time, this retirement, 7 Riskier Retirement, which is the crux of what we have. Be happy to go through that with you as well. Be happy to send that to you. We can email it to you. We can regular mail to you. We can get that to you. No problem, no obligation. All right. I appreciate everybody being here with me. The next one we have is coming up in May. It will be the 24th. And that one is financial defense, make your money last as long as you do. So it's real important that you tune in, tell your friends, they can sign up. We don't bug anybody, it's absolutely free. We help a lot of people. That's what we try to do, is help people. Be happy to help you, be happy to help you or a friend or a family member. 949-219-0692 or info@pfpinvest.com. Thank you all for joining me. I don't see any more Q&A, any more chat. If anyone has a question, do it now, chat or Q&A, or forever hold your peace. Because we will see you next month on May 24th. That is a Wednesday, 3 to 4 p.m. Thank you all. Appreciate you. Jerry Slusewitz signing off. If a friend wants a copy of this, you can also call us, email us, and we will be happy to send you a copy of this because we do tape all these. All right. Thanks again. Have a great day.